What's up guys, in today's video I'm going to show you exactly why I decided to double down my investments on the Acorns platform. And by the end of this video you should know exactly what to do when your Acorns portfolio starts to look like this, where it just goes all the way up and then all of a sudden, oh, it's just trading sideways. Everything I'm about to show you also goes for other platforms you might have, so if you have a Fidelity account or a Vanguard account or you have your retirement accounts on a place that's not Acorns, everything I'm about to say also goes for those too. The first thing I want to say is that this video is not for short-term investors, it's not for stock trading, and it's not for those who only invest a few times a year. This video is for those of you that have long-term portfolios that you invest consistently into and are well diversified, preferably into index funds like the ones in the Acorns app. So without further ado, let's get started here. So for those of you who haven't seen my previous Acorns videos, back in November 6th of last year, I decreased my daily investment amount from about $13 a day to only $5 a day. And I mentioned that I did that because I was saving up for Christmas shopping and the markets were a little on the high side in my opinion, and I wanted to increase my investment back to $10 either by the end of the year or shortly after the New Year's. And so it took me a little bit longer than expected, but as you can see here, I do have it back at $10 a day, and I decided to do this back on February 25th, I think it was. Yeah, as you can see right here, February 24th was my last $5 investment, and then I increased it to 10, and I'm gonna tell you why. So if we just go back to the performance graph down here that I showed in the beginning, as you can see, I've had this account for a couple of years now, and it's done pretty well. And most of this graph is from my contributions, but if you also saw the last video, you knew that I made $5,000 in contributions to this account, and it returned about $1,000 over the course of the time I've had this. But if we just zoom in on this graph just a little bit and go to the 6-month range here, you'll see that my account pretty much went up to about $6,200, and then it was kind of just chilling in the $6,000 range, and then it went all the way up to about $6,400. And since then, we've pretty much been trading sideways, and it's been very volatile. So if you go to the mark where I decided to bring my investments down to $5 a day, that was November 9th or November 6th, like I said. So that was right about here. So right at the point where it started to trade sideways is where I went down to $5 a day. Now, what happened is the markets have been pretty volatile over the last couple months. The S&P 500 and the VOO index have kind of been, just chilling in the $400 range. It went up to about $440, and then we saw that 10% correction down to about $400. And so that's kind of what we're getting right here, because this is obviously 4 different index funds, but a lot of it is weighted in the VOO index. So that's why we're getting this sideways trading. Now, ultimately, the reason why I wanted to increase my investments to $10 a day again is because now that we've seen so much of a correction in this index, I decided that it's time to start picking up these better deals and increase my investment to $10 a day. Essentially what I'm doing here is I'm taking advantage of the fact that the stock market is down because I have such a long-term outlook with my portfolio here. When the stock market is down and the prices of these stocks are cheaper, I like to buy a little bit extra because then in the future when the market recovers again, I'll make even more money than if I just remained the same throughout the crash. Okay, so now I kind of want to explain to you what this whole value averaging concept is here. So I'm just going to pull up the iPad real quick. So let me just draw like a quick little graph of a stock chart. So imagine it's kind of going like this. Now, if you're investing consistently every day or every month or every week like I'm doing, then pretty much what you're going to get is like a general average price that follows just a line that's kind of in between the peaks and valleys like this. Whereas with value averaging, not only are you doing that, but you're also buying more when the graph is around these periods right here. And then you invest a little bit less when the market is at these peaks right here. Because at all of these orange points, you're getting a better deal. So let's pretend that like right here, for example, the price is $350, whereas like at this one right here, the price is $400. So because of the fact that I'm investing long-term and I don't really care about the short-term performance of this, I'm more looking for the 20, 30, or 40-year outcome of these investments, then obviously $350 to buy this stock of VOO is way better of a deal than $400. And so the more that the graph goes down, the more I want to increase my investments. Now, fundamentally, this is pretty much what value averaging is to me. It's the same as dollar cost averaging, except for you're also getting better deals as you go. So this is something that I only recommend to do on top of your investments that you're already contributing on a regular basis. I would not say to do value averaging as a standalone thing, because then you start to approach the whole timing the market thing, and I think that that is pretty unreliable. So always have a daily or a weekly or a monthly amount that you're investing as a flat baseline amount, and then you can add in the value averaging stuff on top of that if you want. So now I'm going to show you guys exactly what I'm going to do based on what the graph does next. So let me just pull up both things real quick, move my face over to this side. So based on the graph that we have here, essentially what the graph is doing is it's, going up pretty steadily if we go back out to the year. And then all of a sudden it just kind of halts and just starts going like this sideways. So basically what we got going on here is we have a support level at the bottom and then we have a resistance level at the top. And as you can see, that's pretty much how the graph has stayed for the most part. And if I zoom in, you can see even more. So all of these bottom valleys right here are all roughly at the same price. And that the chances this market is going to continue to decline, in my opinion, are slightly lower because we've, established that support level. But anything can happen. So if the graph decides that it wants to keep going down like this, then basically what I would do is I would wait until it finds a bottom. So I'd wait until the graph goes down and then maybe like finds another channel to stay in or something like that. And then around this point right here is where I would increase my investment to $15 a day. And maybe even $20 a day if I'm feeling bold. Because the S&P 500, even if the market wants to stay bad for the rest of the year, my long-term outlook is still beyond that 1 year. So the more it goes down, the more I'm going to want to invest in this. Now, what do I want to do if the stock market keeps going up? So essentially what I'm going to want to do here is if the market decides to recover and start going back up again, then I'm going to decrease my investment back down to either $7 or $5 depending on how high it goes. So zooming back out to the full chart again, as you can see right here, for the most part, the graph just stays straight and then it has that, little jiggle that it does right there. So as far as the support and resistance go, you could draw some trend lines to kind of express what this graph is doing for the most part. And it kind of has this channel that's essentially like this. And so every time the market has dropped, it's always kind of bounced back on these little spikes right here. And so essentially what I'm going to do is if the graph decides to go back up like this, then I'll probably increase it to, or I'll decrease it down to $7 a day again. But then if we end up reaching this line up here, and it recovers like a lot more than I'm expecting, then I'll bring it back down to $5 because that is kind of like a market high. And essentially this graph has just been, bouncing in between this range the entire time I've been investing here. So I hope that makes sense. Basically, if the market keeps going down, I'm just going to increase my investments. And if the market keeps going back up and recovers again, then I'm going to drop it back down to $5 a day. But what am I going to do if the graph decides to keep trading sideways like this? So if it just keeps doing this, maybe it goes up a little bit extra, goes down a little extra. Now what I'm going to do here is basically keep my investments the same and just wait it out. And I'm going to wait until it breaks out of this kind of channel that it's forming. And so like I said, if it stays in this range, then I'm just going to keep it at 10 bucks. If it goes down past this line, then I'm going to increase it to 15. And if it goes above this line, I'm going to decrease it down to $5 a day. So that's essentially what value averaging is and what I'm going to do moving forward with my Acorns portfolio. So all I can say, the key takeaways for this video are, if your portfolio is kind of looking like this, don't get yourself down, just focus on the long term and make sure that you're just still investing consistently on a regular basis, because if you're investing in this portfolio, you should have a long-term outlook of 10, 20, or 30 years. And so all of these market corrections and, the market kind of doing bad the last couple months really doesn't matter in the grand scheme of things, because essentially what is going to happen, potentially 5, 10, 20 years down the road is you're going to end up having a graph that basically looks like this. So, for example, let's say it's 20 years from now. So we'll have a graph that looks kind of like this, and then we'll see the corrections that are happening right now on the chart. And then, of course, the market's going to do its thing, and then maybe it recovers again and keeps going this way, because historically that's always what's happened. Now, the problem with investors that are new to this kind of thing and are not used to the risk and the volatility is we are only seeing this picture right here. This is all we see on the phone, is just this little bit. So even though, you could kind of get freaked out by what's happening right here, it's like this is the future potential that we still have. But the deal with this is, if you are investing more during the market drops in this area, then your future arrow is going to look more like this, rather than going out that way. And for those of you who decide to decrease your investments or sell anything or not invest as much during the market crashes and stuff like that, then your future arrow is going to probably be something more like that. So that's kind of why I like to invest more when the markets are down, because obviously you get a better deal. Now, this isn't for people, like I said in the beginning, that want to, trade stocks and stuff like that and have short-term investments or speculative assets. Everything I'm saying is for those who have long-term portfolios. Maybe it's your retirement account or your Roth IRA or your 401k, or just an investment account that you don't plan on selling until retirement. So if you're sitting in that boat right now, just keep focusing on the long term, keep investing consistently, and just see the markets being down as a better deal. So that's pretty much everything I had to say. Just stick with it and don't freak out when the graph looks like that. If you found value in today's content, be sure to leave a fat like down below. And with that being said, thank you so much for watching, and I'll catch you in the next one.